So,
Yeah, I'll struggle. I'll get you on.
all right. Adem, my trading warrior brother, welcome back to F.A.C.E.
Hey, how's it going, Dale?
Good, buddy. So, tell me if my memory is correct. I know you like to buy, outsize move options that, it would take, it's kind of contrarian. And at the time you were accumulating long dollar option positions before it turned into this.
Yep.
I wasn't expecting this much dollar strength. Am I correct? Is my memory serving me?
Yeah, actually, the last big trade, as always, just let the optionality do its thing. I let the black swans do their thing. In November, I loaded up on EWG puts, long dated EWG puts, which is a Germany ETF. And, my thesis was that there's going to be a growing illiquidity pocket, tightening. It's going to lead to stressors compounding in the system, etc.
And you weren't looking for the invasion.
Exactly. And that's the beauty of optionality. It makes the trader seem much smarter than they are, like me. And thankfully, though, I've learned a long time ago that you don't let it go to your head, because you can't price these things in. Like, anything can happen. You can be right about a thesis and still lose money. Like, how many times have you opened a trade? Exactly. There's and I've learned that the hard way.
Wrong the trade.
Yep. And I think that's a big problem that many investors have, is that they confuse being quote unquote right about a hypothesis and still losing money. And then there's me, I was wrong about my hypothesis. I didn't expect Russia invading Ukraine and then the ripple effects from it into Germany. And, it made my puts 500%. So,
nice.
I'll take it. And like you were saying, the strong dollar.
Are you going to share your screen today?
Oh, sorry, I thought I already was. Let me do that.
And are you on one of Elon Musk's spaceships? I thought I heard a wind tunnel or something.
Oh, can you hear? Oh, I'm very sorry about that. Might have been my fan. Is that better?
Yeah, better.
Okay, perfect.
All right, so there's Adem. And,
okay, great.
Where do you study up there on the top of a mountain up there? Is that you?
Oh, I got a ton of just random,
Spaces?
bookmark researches and everything. Yeah.
Yeah. Okay.
But yeah, so I just thought, pick up where we last spoke a few months ago. We were talking about, long dollar. When we're seeing, what's interesting today is that I think this is one of my favorite charts. I've written about this before. This is the Federal Reserve Chicago branch, their National Financial Conditions Index, the NFCI. And this is basically a liquidity index. It's an accumulation of multiple liquidity indicators. And why I like this one is that it also accounts for shadow banking. And as your viewers can see, here are the sub-indexes. So that make up the NFCI. You got risk, credit, leverage. Leverage is the leading indicator of these three generally, since in the post-80s economy, leverage is the key to the global financial system. So what I found very interesting is that the higher the number means the tighter, so less liquid markets are, and the lower is the more easing. And generally, since the 1980s, we've seen a global glut of savings, meaning that and I get a lot of pushback from this, people saying what do you mean there's a savings glut? People don't have savings. That's not what a global savings glut necessarily means. The normal savings, for instance, corporations, the wealthy, even the top 1%, which hold most of all if not all the wealth in the world, the export-heavy surplus countries the Middle East, China, Germany, the European Union, etc. They all have to store their money somewhere. They can't put it under a mattress. They can't just open up a bank account and say, here you go, right? To them, they have to buy usually bonds. They have to find places to put that money. And generally, in a stable or healthy economy, savings is the same or in economic theory, savings equals investment, because every dollar someone like these export countries put in a bank or buy a bond is fueling a creditor. Like America can run the deficits, or essentially there was a study that came out by the Fed showing how the global savings glut since the 80s has essentially fueled the debt trap for the bottom 90%. So the top 10% savings, as they've gotten wealthier, as Thomas Piketty, I think one of the only really important things he even ever said was that wealth compounds much faster than growth. Like the rich money in the bank system compounds at a much faster rate than global growth does. And when you have that happening, you have wealth inequality essentially take off. And so when you're having now investments, net investments over the last 40 years has declined, as we've seen. Businesses in the third industrial revolution, which began in the post 1970s, also known as like the digital age, net investment has been way down. The second industrial revolution, which was between 1870 and 1970, known as the glorious century, where we saw most of the greatest inventions, they peaked out. And since the 1970s, we've just seen instead of a revolution, it's been more of an evolution. Cell phones, for instance, the first cell phone came out in like late 80s. It was a huge thing, and then now it's the iPhones. Yeah, exactly. Yeah, and now essentially this iPhone 3 has been roughly the same, if not faster, smaller, sleeker, etc., more efficient, but it's the same thing it's been for the past 15 years at this point. And that's what we're seeing all over. Like the last greatest housing, like the modern housing setup where you have like a kitchen, installments, like dishwasher, all that was already in the 1930s. The only thing that changed in housing since the 1970s was air conditioning. And so all this new construction that we see, especially after the post-World War II boom, it needed a lot of investment. There was a lot, especially the reconstruction of the world after that horrible war. But now that takes demand, but now, and a bunch of savings. So we had higher interest rates, which makes sense. But now you have a glut of savings. You're having savings essentially exceed investments. So when you're having wealth compounding faster in the bank accounts, and I don't mean individual like the bottom 90%'s wealth. I mean, the ones who actually make it the bulk of the assets in the banking system, their wealth is compounding faster than net investments are growing. So essentially a global savings glut is synonymous with a dearth of investments. And we're seeing that worldwide. And another good chart I like to show is
I wanted to ask you what your thoughts were on what has happened to bond markets and the massive amount. Everyone talks about the negative wealth effect in Amazon and the FANG stocks, but the losses in the bond market, from sovereigns to high yield to corporate to municipal bonds. Can you tell me why some people don't think, especially the way the treasuries have acted, that we're not in a sovereign debt crisis? Do you think we are?
And when you say sovereign debt crisis, do you mean that we're going to essentially the debt markets are going to explode, or are you just referring to like just debt deflation as continued?
It's becomes more, confidence is waning for various economic factors, the percentage of debt to GDP. We can't service the debt. There aren't, the Fed was a major buyer, foreigners backing out. Everyone's saying, well, it's still the deepest market, dollar's a reserve currency, but the rate of descent. I've watched interest rate futures for 1,000 years, and I've never seen this kind of velocity before. Okay.
Mm-hmm.
And I'm wondering, what your thoughts are. I think it's so undercovered. People talking about the great steepening, but I'm just talking about the structure of bonds and no bids, and even when we have big sell-offs and risk, no flight to quality. Maybe that started to happen, but you see no flight to quality, so all you have is selling in the bond market, and the drops were big. What's the impact here?
Yeah, I mean, it's definitely going to hurt individuals, but who are holding these bonds. But at the same time, when they're buying these bonds, they're locking in those rates. And I think with how low rates were, the floor, I mean, we were at less than 1%. And I think rates are still, they're back to where they were in like almost 2018, surpassing 2018 because of inflation expectations. But compared to where the CPI and everything is gone, I actually think interest rates have been pretty tame compared to what we saw in like the 70s, and that just shows that there's such a glut of money weighing rates down. And we also had a negative GDP print in America in the first quarter. I don't think that'll be the last. We're seeing Japan, you're right. Foreigners are holding off on buying. Japan at this point, until their currency can stabilize, I don't think they're going to be buying. They're going to have to be trying to figure out their own mess. China.
How can the U.S. Just their interest expenses doubled in a year?
Yes, that's true. So like, new debt that they have to service. Yeah, their rates have doubled. It's the same reason I don't think Japan blew up or the European Union blew up. We're just seeing this global flood. Historically, periods of great indebtedness are followed by, slowing growth and deflation. And until we see the structural economy change, there's a great saying that says demographics are destiny. And and there's a chart I like right here.
Here, I'm looking at what I'm showing you right now.
Okay.
I mean, is there anything? It looks like a crash.
Yeah, I mean, it does. It is pretty brutal, and I've been holding the TLT. Actually, I bought my first tranche in 2018, so it's looking pretty juicy. But I don't think there's. I mean, honestly, who knows? I don't think.
That's a fair answer, because I feel the same way too. That there could be a face-ripping rally coming out of here. Maybe
I do think there will be. I think rates will go lower in the long run. A lot of these things are cyclical, and I think that's the problem with central banks right now, is that they're have cyclical tools. They're tightening aggressively, and I don't think their tightening is going to do too much. I think as we talked, last time, that there was this is more of a supply inflation. And if you think about it globally, like the supply chains, how interconnected, then you have the economy screech to a halt, and prices rose. We saw like 10% increases just across more of, let's say the CPI rose about 10% across the board. And that's a big increase, of course, was more than we'd have ever seen in 40 years. But for how things had gotten during COVID, I don't think it's as bad if many people actually, sit and think about like, hey, global economy, how interconnected everything is in a bit of a crisis, and not to mention the genius politicians doing these aggressive stimuluses, like pouring fire on demand, like the Fed doing the mortgage bond buying, $3 trillion in bond buying since that to me is, there was no point in that. And I think now they're having to deal with those corrections, and it's going to be sharp and severe. We're seeing mortgage applications and things already sink. And sorry, before we go down that, there's this one chart I like, and it kind of shows the global issue today is that fertility rates are plunging. And like we saw after World War, here's a 220-year history of the U.S. fertility rates. And as you see, it was very high, and it keeps going lower and lower and lower. And then we have this one period also known as the baby boom, and it's from 1945 all the way up to 1960, let's say. And it was as you can see, over 220 years, it was the only period of increase. And that makes sense. The World War II was over. The great baby boom happened. But now all this great baby boom is they're aging. The average worker age by 2030, the U.S. average age of the labor force will be where Japan's was in 2000. And that's not a problem that any central bank tools can fix. And I think and China also has a huge demographic wave coming their way. They have, I think, some 500 million Chinese retiring over the next 15 years. And because of their one child policy, they haven't, had enough.
Them.
Yeah. And like you and I have talked before, how the system, and it actually is making me kind of wonder when we're seeing a lot of the political side. I know we don't like to talk about politics much, but a lot of the reversal of Roe v. Wade talk and anti-abortion, it kind of makes you wonder, is this their attempt to reverse this falling demographics? Because they must know it's a Ponzi scheme, how Social Security works. You have to have the young pay in to keep the old sustaining once they're done adding to the economy. So for every one retiree, you need about, I've read you need about 2.1 workers from some estimates. And we can't have that in this system right now. And yes, America has looser immigration than Japan. Japan obviously has very tight immigration issues. Same with, but the European Union is also having these terrible demographics. Russia's having these terrible demographics. Actually, the U.S. is probably better than most of those countries, but it's still declining.
How come a lot of people explain this real estate boom by there being such a large number of millennial buyers?
I don't know.
Supposed to replace baby boomers, and I've read demographic studies. Things like Dent is pretty big on demographics, and he, that was his bearish argument for the last many years. Was houses don't die, people do, and yet we ended up with this because of what the Fed did, housing shortage.
So exactly that. So I actually think Harry Dent, who, more or less got ridiculed by a lot of the investment world. I don't want to be rude to him, but he was generally right on his great deflation call, because we have had very low CPI until recently, but his practical ideas, market calls were wrong, very wrong, because I don't think he accounted for the cyclical tools the Fed had, like you said. When you have individuals like when COVID happened, there should have been house deflation as people got removed from their homes and had to liquidate. But the Fed came in and the government came in and said, hold up, don't pay your mortgage, don't pay your student loans. Basically, you can live in your place rent-free, all these things. Oh, on top of that, let's do PPP loans, small business, everybody. Let's just, give everybody on top of that, 3 direct stimulus checks. And, to me, that's just the government wanting more control, because if you keep people, at the teat, and then you have more control over them, because if you ever pull back, then the people they can't leave. And so besides of a control thing, it was the government doing a short-term fix to making long-term worse. So all that easing, easing that people were excited for, that extra $1,400 in their bank account, 2-3 years down the road now, we've already paid for it. I saw the average inflation tax for the average American is $5,300 a year. So you got a $1,400 stimulus 2 times, 3 times, and you've already paid for it all in higher inflation 1 year out, and you're going to have to be paying for it multiple years with higher rent and et cetera. So
do you think they'll reverse it and break it, and we're going to have a financial crisis because of what the Fed is doing? Do you think he has a shot for a soft landing? And lastly, everyone's fearing recession. What do you think, buddy? What does
I think we're heading for a global slowdown. We've seen some of my favorite indicators are the South Korean export growth. We've seen that already have compared to its peak just a year ago. It's already missing estimates on the way down, especially with the China lockdown. China's a huge, I think a lot of global economists really that I see, they really discount the China effect. China has basically fueled global growth. I read an IMF study that since 2008, between 2008 and 2019, China alone accounted for 49% of global GDP, and most of their GDP.
I brought that up many times to people. I said, so how could we have it both ways? I remember during the Great Recession, China was still the only engine of growth, and
Yep.
economists were giving them credit that they could help pull us out of it. So, they could
they've
take us
stopped
into
that.
one.
Yeah,
They could take us
exactly.
into one too, right?
And we've seen that happen. You're right. And ever since, so yeah, this chart I have up is just the natural rate of interest, which is where interest rates would be effectively without the Fed.
Go back to your demographic chart. I had a question from a viewer.
Okay.
He wanted to know where I was on this curve.
Yeah.
We haven't gotten there yet.
Yeah. So 2001 was.
I'm at new lows.
Oh, yeah, we are at new lows. Yeah. So
no, he wanted to know where I was personally, and so I'd be, I don't know, maybe another down where the 1 is on the left-hand corner. All right, ride the curve. All right. So
yeah, so like you were saying about China, so another great macro index is the China Credit Impulse Index. And as we've seen since 2008, every time there's been a bust, China has eased. So that will be the blue line. So they've pumped credit into their system.
Right, they're doing it again.
Yeah, and then every time they tried to pull back, it leads to 2014 to 16 slowdown. So they have to ease again. And then they tried doing it in 2000. So finally in 2018, President Xi came out and he said, we're going to switch from low growth investments, which was basically, the fueling property markets, high land growth, all, things that didn't actually help the economy. And he's like, we're trying to go back to high quality growth, which to me meant they're going to try to expand their current account surplus. They're going to try to boom exports. And we saw that. And then they were going on that route. They were tightening. Oh, well, what do you know? 2020 happens. They liquefy, and they were the only country in the world that was dumping their exports everywhere. So even in that supply crisis, we've seen their current account hit multi-year highs because they're trying to export their way out of a recession. But now we're seeing their exports fall, and they started tightening again in 2021 after they got what they wanted. They're not bailing out the world like before. It was just a sharp tightening, but now they're starting to liquefy again. They're actually the only country right now easing.
Yeah.
And everywhere else is tightening. That's why I've gone long China. I think after this brutal sell-off, especially with the Russia-Ukraine noise affecting China, I thought it was a good opportunity to go long China, and I still do. It's not because I like China's fundamentals, like we've talked about. Me liking something or thinking it'll work out has nothing to do with a trade. I just think as a expected value perspective and a contrarian perspective, long China makes sense because credit in the post-1980s hyper-financialized global system, it's credit flows that generally drive asset prices. It's not growth anymore. It's not economic growth. We've seen recessions that doesn't impact markets anymore. Roughly, it's how much growth credit is flowing into the system to pump prices higher. And I think as China's the only one liquefying, yes, they have some noise right now with their China, the lockdowns. There will be noise, but that's why I locked in long-term calls on China just to take advantage of their credit.
Is it on the F.A.C.E?
Yeah, it is on the F.A.C.E.
Okay. All right.
So we'll see where it goes.
Was that supposed to be a secret?
No, it's
someone subscribed.
Yeah, it is for subscribers, but the specific ones I use are, there aren't many,
anyway,
China call.
Sorry,
ETFs.
buddy.
No,
anyway,
worries.
All right, I it's okay.
But that's just one idea that I like, just because, like you said, like China has been such a major engine of growth, the locomotive effect. They are essentially carrying the world.
I know a wave guy who's real bearish U.S. The only market he's constructive on that he thinks is going to make new highs, I think, is Shanghai.
Yeah, and they've had such a brutal sell-off already, and I think just with their many people discount the lag effects between tightening,
how
like
long
we
it
see
takes.
exactly. Like we've already seen the curve invert, and to me that means the U.S. like
wait till QT starts, huh?
Yeah, and that brings me over to this chart. There's been a lot of tightening that's been allowed to happen because, as we see, banks, this is the overnight reverse repo agreement. It's already back at year-to-date highs. It's at 1.9 trillion roughly. And that means there's 1.9 trillion. They have to drain. This effectively means for viewers, what QE means essentially is the Fed was forcing cash, meaning a zero yielding asset, onto the banks and the financial system while sucking out high yielding assets. Banks want yield. They don't want cash. They lend out cash, right? They don't want to pay interest on more cash. They need to make that cash work for them. So when the Fed, hence, that's why they do QE. It's essentially saying, hey, we're going to force you to lend out cash. But you get to a point where you're pushing rope. So they gave the banks, starting in 2020, the COVID, they gave them an insane amount of QE. Essentially, all the QE they've pumped in the market has just been sitting, and banks don't know what to do with it. So they had to send it back to the Fed in the reverse repo. They're like, hey, give us those treasuries back, meaning they were giving them cash and then they were lending them back their treasuries until the QET happens where they can get their treasuries back. And so there's $1.9 trillion. This has effectively been a soft tapering, if you think about it, because the banks didn't lend any of that QE. It's just been sloshing around in the cloud of finance, allowing Wall Street and asset prices to boom ever higher, the cheaper margin. And while nobody else says, we actually see loan and leases have been declining steadily the last 40 years. So the demand for money has eroded in the real economy, but in the cloud of finance, there's never been more money sloshing around.
Great interview, Ed. Like
usual.
I
really appreciate it, Dale.
Adem, you want to show your website so people could,
sure.
Even though they know about F.A.C.E secret?
No? It's just one of many. I mean, now with all these sell-offs and everything, it's
and great call on the dollar, buddy.
So thanks.
Yeah, I think you're very insightful guy, and I'm a fan.
Let the black swans do the work for me, and get to just read books and
Well, when I was in Chicago, I didn't see a lot of black swans, but I sure was dodging the pigeons waiting for the train.
Right.
So there's where you could follow Adem and check out his website, and
you guys can check out my Twitter if you ever need anything, and
and the radical's good because it's his thinking. He has radical thinking, and how many people put on trades they may not be bullish on, but it makes sense market wise.
Right. That's one of the greater things I learned from Nassim Taleb and his group is that, you just can't confuse genius with luck and what's right or wrong with profit or loss, because they do not follow each other.
Yeah. Well, you learned it early. Takes people a lifetime.
Huge losses made me rethink everything. And since then, it's been a lot better. But, it happens. Everyone has to suffer a big blow.
And as far as the markets are concerned, everyone put on a little Jimi Hendrix today and listen to Manic Depressions, a Frustrating Mess. So that's what I think we have. We have manic markets, and that's why you take it when you have it too. Or you go with the telescopic method like Adem does, and you go out and you buy a lot of time. At Radical Adem, Richard. ADEM. All right, my trading warrior brother. I'll get a hold of you on Twitter, and we'll schedule your next one.
Yeah, it's always a pleasure, sir. And I hope everybody else has a great day, and good luck out there.
Yeah, good luck on this China call. I'm going to maybe put some on.
Well,
so I could blame you. So I could blame you when it doesn't work out.
All right. No worries, sir.
Look, I'm a big boy. All right. Adem Tumerkan, really great to Tumerkan, really great to talk to you today.
Great. Thank you, sir. Have a good day.
All right. Bye-bye. Don't call me sir anymore, okay?
All right, Dale. Take it easy.
Dale, there we go. Adios, everyone. I thought you enjoyed it. Hope you enjoyed it. Yep. And the team will be there in 14 minutes, go over the bias charts and many other things. And what, great news about the Flow Show coming up with Ryan, and think that K-Man's great, and you ought to get in the chat room and see some of Amanda's calls. I see them come across all the time on TradingView. So we have a good team, and they all care about you. So remember, most of all, don't just count your pips, count your blessings, and find a community of like-minded people to hang out with. Adios, everyone. Thanks again, Adem.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.